Take a look at this listing in San Antonio. It was originally on the market for $350,000. Then they cut the price to $320,000. Then they cut the price to $270,000. Now they just cut the price by another $40,000 down to $230,000.
But CBH Homes, which is a big builder in Boise, Idaho, and throughout Idaho, saw 1/3, that is 1 in 3 of all of their contracts cancel. That's twice the level they saw just in January.
Home sellers are becoming concerned as the once-hot housing market softens rapidly. According to Realtor.com, 1 in every 5 sellers reduced their asking price in August. That figure was only 11% a year ago. For the first time in over 17 months, the average house sold for less than its list price. New listings hitting the market are down about 14% compared to this time last year. On the other hand, pending sales are falling even further. So the number of properties under contract is down 30%, and this has been the case for the previous few months. There are many fewer properties under contract now than this time last year. There are just fewer buyers available. As a result of fewer purchasers, houses are taking more time to sell. Well, let's hear Nick's current assessment on the housing market.
Sellers on the U.S. housing market are freaking out right now, and we have now entered what I call the second wave of price cuts in this 2022 housing crash, where we're seeing some crazy reductions. Everyone, take a look at this listing in San Antonio. It was originally on the market for $350,000. Then they cut the price to $320,000. Then they cut the price to $270,000. Now they just cut the price by another $40,000 down to $230,000. And the great thing is that now these price cuts are reaching affordable homes. At first, in the first wave of cuts in June and July, it was mainly higher end, larger, more expensive homes that were reduced in price. But now it's homes at all price points. They're starting to get big reductions, specifically in certain cities, everyone. If we look on this table, we can see that there's really 3 metro areas that stand out in terms of price cuts. Phoenix, Austin, and Vegas, where nearly 60% of all of the listings currently on the market in these cities have a price cut. As a home buyer or real estate investor, you need to understand a big trend, a big shift that is occurring in the US housing market right now. And it's a geographic shift where the places that boomed during the pandemic, they are no longer booming. In fact, they are the housing markets that are crashing first. And this is something that the institutional real estate players are now catching on to, particularly Redfin. If you go to Redfin's website, they have some great articles that come out every day on the US housing market, but I thought their last 3 articles were really interesting. Take a look at this, everyone. Starting from the bottom, Redfin had an article a couple days ago about how Sun Belt home buyers are backing out of purchases and canceling their contracts higher than anywhere else in the US. Then they had an article the next day talking about how more than half of US home buyers want to live somewhere with legal abortion. And so I thought that was very interesting, those articles back to back by Redfin, because they're kind of painting this narrative, they're painting this picture of, oh, people are canceling contracts in the Sun Belt. Why are they canceling contracts? Well, maybe people don't want to live in states with strict abortion laws. I don't know if that was Redfin's intention, but that's how I was reading it. Is then they followed it up with another article talking about the fact that markets like Chicago, Albany, and Milwaukee are among the housing markets holding up better than anywhere else in America, pointing out how it's these Midwest and East Coast metros that are doing the best. And so what I want to get all of you as home buyers or real estate investors ready for are 2 things. One is the migration shift that I believe is already occurring, of fewer people moving to the South and more people moving back to the Northeast and Midwest. Potentially even the bigger impact is the narrative shift that is going to occur, where institutional real estate investors are going to bail on these Sunbelt housing markets that they invaded during the pandemic, whether it's Jacksonville or Atlanta or Dallas or Phoenix, where these investors are buying 30 to 40% of the homes. They did that based off a narrative that people would move to these cities forever, that these cities would boom forever. But that narrative is actually never supported by the data. If you look historically, you can see that there's periods where people move to these cities and then leave these cities. There's a 10-year migration cycle in America that repeats fairly consistently. So now that the mainstream narrative is now shifting, we can see Redfin pushing now a narrative of the Sun Belt isn't as good, the Northeast and the Midwest is better, we're going to see the real estate investors follow that narrative. We're going to see them sell out of the South, and we're going to see them potentially buy more in the Northeast and the Midwest. But I think more likely it's going to be a lot of these investors are just going to sell out of the South, pocket their cash, and move on to doing something else over the next couple years as the housing market in America crashes more broadly.
In July, the National Association warned that we're already in a housing recession. New construction home builder prices, that is prices for new construction homes, have risen to the highest relative income level that we have not seen since the 1980s, when we had substantially high inflation. It's no surprise that home builder construction activity and spending is starting to inflect down. Now, home builders did something really funny. As they waited for supply chains to catch up, they actually purposefully didn't put homes on the market because they thought, hey, well, the market's appreciating. Let's just wait to put homes on the market. Because we'll just be able to sell these properties for more. Like, why lock in buyers at early prices when we could just wait because prices only go up? Construction spending is declining, and it's all happening naturally because it's becoming a lot harder to actually sell new construction homes. We're seeing cancellations that we haven't seen before. According to Pulte Group, D.R. Horton, and Lennar, all of them are seeing an increase in cancellations in all of their markets. But things get even worse in specific markets, especially the Zoom towns. Remember, the Zoom towns are towns like Phoenix, Boise, Idaho, parts of Florida, and these are areas that are not bad areas. They're just areas that are going to get hit by this housing crisis even more than others. But CBH Homes, which is a big builder in Boise, Idaho, and throughout Idaho, saw 1/3, that is 1 in 3 of all of their contracts cancel. That's twice the level they saw just in January. And a lot of people in January, myself included, were already screaming, uh-oh, might not want to buy real estate because we might be at the peak. And so, compared to January, we're at twice the cancellations in Idaho. You look at this chart, and you look at mortgage demand. Not only has it fallen off a cliff, but if we draw the bottom of this cliff all the way over to the left side here, we see we have not actually seen this low level of mortgage demand since 1995, 1996-ish, right around that region. That's insane. I mean, that's a massive, massive plummet in mortgage demand. So you're seeing less people buy homes. You're seeing more cancellations, but you're also seeing a larger backlog of new construction, and this is actually what's creating a crazy opportunity.
The consumer-driven desire to buy a house has slowed dramatically as mortgage rates have gone up, a pattern that is clearly mirrored in the number of current property listings. According to a recent Federal Reserve Bank of St. Louis research, 376,000 properties were listed in February 2022. In May 2022, the figure had risen to 516,000, a 37% increase. Homes appear to be remaining on the market for longer periods of time, with fewer offers being made on each property.